we are the developer, and we hire out all the different third-party companies. So that's a great point. But there's a distinction between the actual developer and the construction company. So we do not have in-house construction. We do not have in-house property management company yet. So yeah, we hire out the construction company, the property management company, the civil engineers, the architect, design team, and the developer is kind of like at the top of all that, kind of just managing all these different third-party companies with the goal to, in the end, build the property. Yeah, we hire out all those different third-party companies.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Justin Goodin. Justin is the founder of Goodin Development, a multifamily development firm based in Indiana that enables busy professionals to invest in real estate without the demands of being a landlord. And in just a minute, we're going to speak with Justin Goodin about multifamily development. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Justin Goodin. Welcome to CREPN Radio.
Thanks for having me on there.
I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Of course. Well, today I'm a multifamily developer here in Indianapolis, Indiana, and started this firm about a year ago to strictly just focus on, Class A ground up multifamily development throughout Indiana. But yeah, it didn't always start like this. I got started in real estate by investing in fix and flips and rentals in and around Indianapolis. I was doing that through business school. I studied finance, graduated business school, and eventually started working as a multifamily underwriter for a bank here in Indianapolis as well. And while working at the bank, I really got a inside glimpse of the huge benefits of commercial real estate, apartment investing. I kind of saw everything on the back end of that. I mean, as a underwriter, you see everything. You see the borrower's tax returns, their income statements, their balance sheets, and I just knew I wasn't going to achieve any of that by working behind a desk my entire life. So left my W-2 job to pursue apartment investing full time, and my first property was a 33 unit in Indianapolis. Eventually scaled up to do more syndications with other local partners here as well. Eventually landed around 500 multifamily units, all on the existing kind of value add business plan, and eventually scaled into ground up development, which I'm happy to talk about more. But today, that's our sole focus is just growing on the development side, throughout Indiana.
Oh, that's awesome to have the banking experience there to understand the numbers and know what the banks want, to where you can make certain you're an attractive option for the banks and know how that works. And then also to have the more the hands-on experience from working with the value add and working from that into development, which if there's truly a value add opportunity, I would say development probably fits that, taking something from raw ground to full development. So congratulations to you.
Thank you.
So as far as the ground up development, I guess the first question I would have is what kind of a lead time do you expect or experience from when you identify a plot of bare land to getting it through to occupancy? What kind of a timeline would you expect that to take?
Yeah, great question. I'd say, I mean, of course, it depends on the situation, the municipality, but I mean, generally speaking, you're looking at a few years. So it could take you between 6, 8 months, 12 months before you actually like break ground on a property. Again, it depends on the situation, but if you're finding a raw piece of land that needs rezoned or entitled, to go through that process could take 6, 8, or even a year to do that. And then you're looking at a period around between 14 to 16 months for construction, possibly longer for larger size properties, and then for your lease up and stabilization, another 4 to 6 months to stabilize the property. And then at least like for us, we're looking to sell our properties after construction. So personally speaking, like we're looking at around 3 years as a all-in whole time.
Gotcha. And when you were doing your value add on existing properties, how that timeline compare from identifying to, I guess, close or I guess, well, walk me through that just from acquisition or identify, close, whatever value add component you were going to do, and then disposition. What kind of a timeline were you work on there?
Yeah, I mean, on the value add side, strictly speaking, on the acquisition side, I mean, you're looking at a property and potentially making an offer on it within a month or so, give or take. Typically have, around 60 to 90 days to close the property after you go under contract. And we were projecting hold periods around 5 years on the value add side. And I mean, so a huge difference between buying existing properties and now on the development side. For development, we have a project right now that we're breaking ground on this year in 2025, but I actually made the first offer on the land and got under contract close to like 11 months ago. So it just depends on the situation, what needs to happen with the land. But yeah, definitely like a longer time horizon on the development side.
Got it. And then you said on your development side, you hold these basically once you get them leased up. Is that when you go to sell them, or how long? What's your typical hold time on a new development?
Yeah, strictly speaking, for like what we're doing, at my company, like we're not looking to hold on to these properties long term. We are looking to just like quite literally build them, lease them up, and sell them as quickly as possible. And reason being is just like asset management. I mean, as you know, it's just like a totally different business. It's just a whole separate thing that has to come into play after you buy or build the property. And for me, like I just want to do like one thing really well. That's development. I want to put like all my time and focus on development and do that really well. So like anything I think that kind of takes my time away from that is kind of just distraction or noise. So for me, we're just looking to build, lease up, and sell as quickly as possible.
Got it. So, and if I understand right, your primary area that you develop in is Indianapolis and thereabouts. Is that correct?
Yeah, in and around Indiana. I have no plans on going outside of Indiana for the time being. And again, kind of just being like laser focused on one thing. Like I really just enjoy being laser focused on one thing. And for us, that's just doing Class A ground development here in Indiana. I personally think when you're just like, looking at all these different markets and different asset classes and this and that, you kind of just drive yourself crazy. Like you're not like really an expert in any one thing. And I mean, I just like staying focused. So to answer your question, it's just going to be here in Indiana that we're building properties in.
Got it. For the properties you're developing, what's a size range of the multifamily properties you're developing?
Between 50 and 150 units. Um, yeah, strictly, yeah, on the residential side, 150 units. And we do have some commercial and retail as well. So like we're doing like the mixed use property. So aside from the residential units, there are like, there's commercial and retail mixed in with the property as well.
Got it. And as far as the way that I get that you're in development, I mean, that's your focus. But as far as the capital stack, are you raising capital? Are you going to investors? Are you primarily working with the bank? How do you account for your funds you need to do your developments?
Yes, our capital stack looks like everything you just said. So we're having a bank loan, typically around between 50 and 55% loan to cost. We're raising equity from retail investors, friends and families, things like that. And at least like for us, we're also working in different municipalities. So typically in our capital stack, we are, partnering with the city or town that we're working with as well. It's for what we call a public-private partnership.
And if you could explain a little bit about how that public-private partnership works.
Yeah, of course. So, as we're sitting here in 2025, it's extremely difficult, if not impossible, to get these high quality Class A properties to pencil out on paper unless the city or town wants to invest in that project. So that goes in the project as real equity, real money. It doesn't make us, the developer, any richer. It doesn't go into our pockets. It simply makes the project market feasible. So, our construction cost is what it is. I mean, it might be, as an example, 10 million. And let's just say, after we cut the ribbon, after it's all said and done, the project may be worth 7 million. And, that's a direct result of the rents and what we can charge for the property, and the product of the income is what drives the value. So that gap between the 7 million and the 10 million is where we work with different municipalities to fill that financial gap. I mean, if that financial gap is not filled, then projects don't happen. And that's why you see like, different, areas around your city you live in. Like there's areas of the city that are really nice, developed. There's always new apartments, always new buildings going up. And then there's other cities or towns, other, smaller places that just don't have any of that. Like they kind of just get, left behind. There's no development. There's no new apartments. Cities and towns that work with the developers, that partner with developers, those are the areas of the city that you see more developed and just more, more desirable to live in.
Got it. So on that, the part that the municipality participates in, is that come in, or does it come as like tax offset, or is it actual cash contributing to the project, or is there like a requirement that it be designated X% for like a low income housing, or how is that structured from the municipality?
Yeah, I mean, all those things you just mentioned are all different ways to structure that. Like for us, we're not doing like any kind of affordability restrictions. All of our properties are 100% market rate. So yeah, we're using things like forgivable loans, tax increment financing. There's a number of different things that are out there that municipalities use, and it's all public information. But yeah, there's a number of different strategies that you can use as a developer and partner with different cities and towns.
So do you find that the municipalities that are wanting to participate or work with you, are they more in what's the zones? I can't remember the name of the zones that Trump, when he was first president, created opportunity zones. Are those do they fall in those areas, or is there just an area that the city has designated that they want to increase the density?
Yeah, the second one. We're just finding the best location, the best real estate possible, and we're going to the city or town and finding a way to partner with them to make this project possible. So yeah, I mean, all
Got
the
it.
different municipalities usually want apartments, they want growth, they want people living in there. I mean, all growth starts with housing. Companies, businesses are not going to come into an area just randomly. Like they're going to come into an area when there's a large population of people living there, working there. So I mean, all growth starts with housing, and a lot of different cities and towns they realize that. So they really want these projects and they want to partner with developers to make this happen.
Got it. Do you find that having a partnership with a municipality helps you with getting your plans approved and all that? Is there any kind of a correlation between you have a partnership project, or are they totally unrelated?
Uh, More unrelated. Like our projects go to usually like city council. It goes to like an approval process. I mean, yeah, you could make the argument that if we're partnering with the municipality in some way, that they would most likely want to see this project go through, or else obviously it doesn't happen. But yeah, it still goes through the same approval process. Still, go through like the same rezoning process. All that is handled absolutely the same as any other project.
Got it. And as far as your lenders go, then how do they treat that participation from the municipality? Is that are they, or is it deeded, or how's that all work? So that, or is it a loan, or just kind of curious how I know the lenders sometimes kind of get a little particular about where they fit in the capital stack.
Yeah, I mean, the city, the town that we're working with has no ownership in the deal whatsoever. Like, I mean, there's no restrictions on the property whatsoever. So there's some gymnastics with the paperwork and the loan approval process, but I mean, generally speaking, it's just more equity going into the project. So the lender, has really not a lot of pushback. I mean, they want to do projects like that have that participation because it's just more equity and a lower loan to cost for the bank.
Got it. Got it. So on the properties that you've done, how many have you taken a full cycle from in development to a disposition?
On the development side, none. We have one as we're speaking here in January 2025. It's about 75% complete. And yeah, looking to start leasing that one up in April of this year. And we have another one that's breaking ground in April of this year as well. So these are the first two that are kind of getting going here.
Gotcha. And as far as the lending environment, I mean, or let's back up. The demand for housing, are you seeing any fall off on demand for housing? Is there any threat of overbuild in the area you're in?
No, absolutely not. Indiana is not even within the top 10 most oversupplied markets. We're still achieving around 4% rent growth in 2024. There's 4% rent growth in Indianapolis. So there's still a ton of demand for multifamily. And as you look at these like recent supply numbers that are coming out, supply is really high in 2024. It's pretty adequate in 2025 as well. But after that, you see supply just like tanking and then going off a cliff. So I think right now is a amazing time to be a developer because we're going to be continuing to do projects in any market cycle and any interest rate cycle. I think like as this supply is dropping off the cliff, and developers that are still continuing to do projects are going to be much more profitable, lucrative in the coming years because there's just not a lot of competition that's in the pipeline.
Yeah, if there's demand's higher than supply, that's always a good position to be in there. So with that said, how have the interest rate how does the interest rate environment play into your development plans? Are you feeling any headwinds, or do you feel like the market's pretty much in agreement, especially with your partnership with the public-private situation? Is there any any interest rate sensitivity to that?
I'd say that interest rates make it more difficult to build properties. It gets it's more difficult to pencil out and makes it more difficult to sell a property. Like we have no idea where interest rates are going to be when we go to sell the property in 3 years, which, is going to, I think, directly correlate with how much a buyer is willing to pay for our property. So yeah, just the interest rate environment just makes it more challenging to get deals to pencil out, and then also on the sell side as well. Yeah, I will personally say that I've never done a deal that has a floating interest rate component to it. Not to say that I won't in the future, but fixed rate has been a product we've utilized on every deal, even our first ground development deal, fixed rate construction loan, which when we started that about a year ago was we locked it in at 6.85%. And today, as we're speaking, if we didn't fix that rate, it would be, above 7.1 as of today. So yeah, I've always done fixed interest rate, but I'm not saying I won't change it up in the future.
Right. Well, it's always nice to know what your costs will be as opposed to their what. I know there was a time there during the pandemic when money was fast and free, and I think some of those people are in a little bit of a challenge right now based on rate change there. But yeah, good to have those fixed costs. So as far as your capital stack and your investors, do you actively raise capital outside of, like you said, the friends and family, or are you doing any active capital raises?
For the accredited and non-accredited investors, for all of our projects. I will say, like, in the beginning stages of our projects, we don't start raising capital from day one. So, if I find a piece of land and it needs to get rezoned or entitled, like we spend all that upfront due diligence cost on our dime. Like we pay for architects and civil engineering work, rezoning costs. Like we do all that with our own capital and only bring investors in or work with investors when we have a project that's shovel ready to go, going through we have our bank lined up and ready. Only like when we're in the final stages to actually close the project and get it started is when we start raising capital and working with investors.
Got it. And as far as the capital raising, how much time do you usually allow, or have you needed to accomplish your goals from when you, like, say you got everything lined up, you're able to present it to investors to closing?
Between 60 and 90 days is what it's been in the past.
Okay. So you've got a pretty good pool of prospective investors, it sounds like, you're in touch with. Is that fair?
Right.
Gotcha. And so you said you've got one that's near completion. How many units is the one you're in construction with right now?
84 residential units. It's 15,000 square feet of office, and then around like 5 small commercial suites that are rented out to local and small businesses as well.
Yeah, is that like a metropolitan or a suburban area? Whereabouts is that located?
Yeah, it's in Fishers, Indiana, which is just 10 minutes northeast of Indianapolis. Very high income, very thriving area of town. Located in Hamilton County, which is the fastest growing county in the whole state of Indiana.
Gotcha. And you've got another one you mentioned you're set to break ground on, or we're in 2025. When do you expect to break ground on that, and how many units is that?
April of this year, we're expecting to break ground. That one's 114 residential units and 3,000 square feet of commercial on the bottom floor. $26 million project cost, located in Kokomo, Indiana, which is about 45 minutes north of Indianapolis. And really excited about that one as well.
Got it. And on the Well, do you expect to do any additional projects in 25, or is it just more kind of on the lookout and trying to sow some seeds of opportunity?
Oh yeah, I mean, absolutely. Yeah, I'm looking to announce three more projects in 2025 this year. I won't get started on that this year, but yeah, my goal is to announce three more this coming year. And yeah, I'm not the developer or operator that's has like any kind of unit count goals. Like you'll never see me like online talking about that we want to get to like 5,000 or 10,000 units. Like I've never been that type of real estate investor. I'm more interested in growing slowly and consistently over time, only doing projects that I'm just 110% confident in, whether that's, one deal a year, three deals per year. I'm only interested in growing slowly and surely over time.
Gotcha. And I meant to ask you earlier, but I want to come back to it. Goodin Development. How are you guys? Or how are you staffed? Or do you have project managers? Do you have? Tell me a little bit about how you're staffed.
Yeah, so we are the developer and we hire out all the different third-party companies. So
Okay.
that's a great point, but there's a distinction between the actual developer and the construction company. So we do not have in-house construction. We do not have in-house property management company yet. So yeah, we hire out the construction company, the property management company, the civil engineers, the architect, design team, and the developer is kind of like at the top of all that, kind of just managing all these different third-party companies with the goal to, in the end, build the property. But yeah, we hire out all those different third-party companies.
Gotcha. And have you been able to use the same firms from project one to project two, or have you kind of expanded your Rolodex of providers?
Yeah, I mean, exactly on your first point, we're using the exact same team on the first project as we are on the second one. So yeah, taking the same construction company, same architect, civil engineer, same banking relationship, and yeah, doing all that onto our second project.
That's great. That's good. Cool. Well, hey, Justin, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker. And as such, I like to work with my clients or I do work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk, and that's not an option. We look to see if there's a way we can minimize the risk. And if we cannot minimize or avoid the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your investors, the municipalities, the Fed interest rates, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Justin Goodin, what is the biggest risk?
So, I mean, my job as a developer is to obviously build the project on time, on budget, multiply my investors' equity. The biggest risk for somebody in my position is the uncertainty in the market in that 3-year time frame down the road when we go to one, lease up the property, sell the property, but we have no idea where interest rates are going to be, where cap rates are going to be, how the market is going to be in 3, 4, 5 years down the road. So that I think is the biggest risk to me as the developer. I could build an amazing project on time, on budget, but when I get to the finish line, I go sell the property. Who knows where the market is going to be? Who knows where interest rates are going to be? But I did everything right on my part for the past 3 years. It just so happens now that cap rates expanded, values are down. Maybe that affects my refinance proceeds. Maybe that affects what the buyer can pay for my property. So I would say, yeah, just that uncertainty of how the market is going to be in 3 years is my biggest risk as a developer.
Yeah, always an issue, definitely. Do you find in your market in general, in Indianapolis and just kind of the Midwest there, do prices tend to be more stable, or do you find that it's interest rate sensitive like everywhere else?
I mean, sensitive like everywhere else, but I would just say, as a whole, the economy, the market, occupancy levels, are very like stable, very consistent in different parts of the Midwest and Indiana, especially. Rent growth, I mean, very stable, very consistent. There are really like only like a handful of cities right now in the entire nation that are still achieving, positive rent growth. And like I mentioned in the beginning, but Indianapolis right now, or at least in 2024, was still at around like that average 4% rent growth, even still today. So very stable, very consistent. And we just don't see like those large swings and fluctuations here in Indiana as compared to other markets.
Yeah, no, that's always an attractive thing when to have some sort of a trend line that's consistent as opposed to the yin and the yang, the up and the down and the wild swings. Sounds good. Hey, Justin, where can the listeners go if they'd like to learn more or connect with you?
They can go to goodindevelopment.com. That's GOOD as in dog, IN, development.com. And also on LinkedIn and Facebook, just my first and last name, Justin Goodin.
Got it. Well, Justin Goodin, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.